Qualitas is an alternative investment manager specifically focused on real estate. We look at both debt-based strategies and also equity-based strategies. Our debt strategies are predominantly in the form of being an alternative lender to the banks in the real estate market for large wholesale lenders. That comprises about 2/3 of our total portfolio, and we're a provider of first mortgage loans, construction loans, investment loans. We do a little bit of mezzanine debt loans, so it's quite a large strategy for us. And then we have a equity portfolio where we're looking at more long-dated, what they call WALE transactions, weighted average lease expiry transactions, opportunistic investing, particularly in the development type market. So that represents about 1/3 of the total Qualitas operation. You really need to tailor that to the appetite of the investor that you're dealing with, and because each has a relative risk and a relative return proposition. And I think that for the vast majority of investors, I really like the debt area as an investment area. I think it offers extremely attractive risk return proposition, and I don't just say that relative to Australian equity investment, but I also just say that on a global basis, that I continue to feel that the returns from debt investment in Australia is very attractive type returns. A lot of our investors are really searching for income. It's very difficult in the current environment to find investments that people can earn a reasonable rate of return, have a good night's sleep in respect of where they've invested their money. So being able to invest in a first mortgage, know that you're well secured, you've got third-party equity that's acting as a cushion for any asset value reductions that might occur due to economic or cyclical type matters, really provides a great basis for investment and enables investors to earn a very predictable, very stable source of income, which a lot of investors are looking for at this point of the cycle. Well, Qualitas foremost is a capital allocator. So we run a fund strategy. We work with third-party developers and investors in the market. So we need to look at how do we influence the areas that we've identified as being important to us in ESG. And so we do that through the capital allocation model and say, we have some funds such as our Qualitas Build to Rent Impact Fund, debt fund, which has a very specific ESG focus. That particular fund has a focus on climate change. So on the E for environmental change, we've really chosen climate as being the area we're most focused on. That particular fund is looking to reduce greenhouse emissions by 35%. So that's our way of saying to the market that if you want to access Qualitas capital for build to rent multifamily development, then in order to do so, you need to be able to demonstrate to us your commitment to environmental sustainable development. And in particular, we've set a benchmark of 35% reduction in greenhouse emissions. So I think that financiers have quite a large role to play. It doesn't need to be just driven by the developer community, but I feel that if, as a financier, if we can identify areas of the capital, in this case the debt markets, that may be harder to access, we have a solution, but it's subject to finding ways to improve the areas that we feel are important to us, then that's a great way for us to contribute back to society on these types of matters. So build to rent is a concept, in other parts of the world it's known as multifamily, and it's a concept that is well understood in the US and Europe. There are many forms of it, but probably the best way to think about it is, in Australia, typically we've built high density buildings, residential buildings that we've strated and sold on an apartment by apartment basis. What build to rent entails is not the requirement to sell your apartments. They are owned in one line, so you have one investor that owns an entire vertical building, and it's built specifically for the purpose of rental to third parties. So it'll always be owned in one line. It's a different design to how one thinks about build to sell, because it's really about creating communities, and it's about the more public amenity in the building to create the community in those public open spaces. And as I said, it's very popular in other parts of the world and certainly gaining traction now in Australia as well. I think you consider an exciting opportunity for the same reason you may consider office or industrial or retail an exciting opportunity. You know, it's an ability to own real estate where you earn very long forms of income. You know, one of the benefits of build to rent is that you have hundreds of tenants in your building, therefore quite a large diversification of income and an ability for investors to really just enjoy long-term forms of income, enjoy capital appreciation on underlying land and buildings. And you know, it's a great proven form of real estate, and not necessarily so much in Australia because it's still a nascent industry in Australia, but certainly, as I said, in the United States and, you know, Europe, places like Germany, it's a very well understood asset class.